everyone. I'm Carol Massar of Bloomberg Business Week on Bloomberg Radio and Bloomberg TV. We're going to talk about the agitators that are out there, especially when it comes to talking about ESG in the investment space, but also environmental, social, and governance issues overall. We have a great panel to do so, and let me introduce them. Tariq Fancy, he is founder and CEO of the Rumie Initiative. He's the former Chief Investment Officer for Sustainable Investing over at BlackRock. We also have Laura Murphy. She is president of her own company. She is a pioneer of the corporate civil rights audit. She's worked with Facebook, Airbnb, and others. And also Barbara Ann Bernard. She was investment banking at Goldman, alternative asset management at Deutsche Bank. She's now founder and CIO, of Wincrest Capital. She began working her career, she was 15, with Sir John Templeton. So we have a great panel to get into this discussion because there's so much going on in the world when it comes to making things better. And we see a lot of investment money flowing into the ESG space. Let me just throw out a quick stat. Global sustainable mutual fund assets hitting a fresh record in the second quarter. So we're now seeing ESG funds with combined assets at $2.3 trillion, the fifth consecutive quarter of growth. This was after a record year last year. Bloomberg has reported that ESG assets may hit $53 trillion by 2025, making up about a third of global assets under management. That's going on. And at the same time, what we're seeing is advocacy groups. We're seeing shareholders, stakeholders increasingly call on corporations to be better, do better, and to measure what they are doing so that they can actually be and do better. So we're asking companies to do civil rights audits. So we're going to get into all of this. Let me start with the ESG side of it first and the investing angle. Are investors being duped by ESG investing? Tariq, you were the chief investment officer of sustainable investing over at BlackRock. Over the summer, you outlined why you now think sustainable investing is a dangerous placebo that harms the public interest. How did you go from being, for lack of a better word, kind of the mouthpiece of sustainable investing at the world's largest asset manager to someone who's pretty critical of it?
Well, so thanks for the opportunity to speak today. And, I would say that I wouldn't cast any aspersions on anyone in this space who believes a lot of the major narratives today. And I would say that because I believed them going into it, right? I drank the Kool-Aid, and I believed that this was a way that we could, effectively drive both social change and better investing outcomes. So it's an alluring win-win. And what I tended to find when I went in there as a trained investor who had not only done ESG, had done investing across the board, at sort of with a hedge fund background, that, ESG is kind of become all things to all people, right? There's an argument that it improves investment returns, that it improves society. And what I found was that it's useful for investing in a few instances. And, there's a kernel of truth, but that, where purpose and profit overlap, but it is being blown into something far larger than it is that doesn't really work across the board. And secondly, it seems to have no clear social impact from what I can tell. And that's quite dangerous because some of the research I worked on subsequently showed that actually the narratives and messages around ESG, sort of as this magical panacea for climate change and social change and so on, actually just creates a deadly distraction where people are less likely to pay attention to policy and government-led reforms that our experts in society are telling us actually will address those problems.
One quick follow. When you were at BlackRock, did you feel like you were inside and could leverage your role? Did you feel like you had a platform to do so? Were people listening? Was Larry Fink listening?
I think people were listening, and they were trying to sort of do the best in the room that they have. I think the challenge is that not that, a firm like BlackRock can solve all of our problems, and they're not. I think the challenge is that they can't, but they're saying, or they're incentivized to imply that they can. Right. So the answer to climate change is clearly, Nobel Prize winning economists are telling us it has to be policy reform. Starts with a price on carbon that is a systemic reform that, addresses a systemic problem. That has to be government action. And I think that the economic system is being so seized by a set of narratives that have underlie the system and are almost invisible that emerged in the 80s that tell us that free markets solve all problems. That even when faced with market failures, 13 years after the financial crisis, we're still sort of hitching our ride to a set of solutions that don't really work. And the problem is the asset management industry is incentivized today. No one wants taxes and regulation, even if that's clearly the solution, right? And climate change is going to cost money. Someone's going to have to pay. And so faced with that reality, there's an incentive to sort of take one hand and hold off taxes and regulation with a set of narratives that say that business will solve these problems all by themselves, kind of like a sports game where, the athletes say, oh, we don't need referees, we'll self-referee, and good sportsmanship's the answer. And then into the growing social angst that starts to develop because people see nothing getting done on these major problems, then there's an incentive to sell a bunch of products that, for the most part, have no empirical evidence at all that they create any kind of impact or lower emissions, but are lucrative, particularly for financial, for asset managers who are facing fee pressure for, largely increasingly commoditized products.
Barbara, I want you to come in on this because over the summer we did see the European market for sustainable investing contracted by $2 trillion. There was kind of a rethink, right, because of the introduction of anti-greenwashing rules. So does that tell you that maybe we're getting smarter about ESG, or do you still think a lot of the ESG that's out there is nonsense?
I think ESG needs to be disrupted. I believe in ESG 2.0. And ESG 2.0 is about materiality and authenticity. And that's the portfolio that sits at the intersection of profit and purpose. So I believe in a lot of what Tariq said, but I'm not as jaded. I'm hopeful. And so I think ESG 1.0 was either investing in naturally low carbon tech companies or the index hugging just slightly overweight tech, slightly underweight energy. And that is nonsense, and that is greenwashing. And when you talk about those big numbers in ESG, the problem is 70% of ESG money is passively invested. So we will not have an energy transition unless we have an investor transition. And so the reason Engine 1.0 was so popular, or Engine number 1 was so popular, I think, was it enabled these large passive asset managers to tick an ESG box without changing their passive investment strategy. So I'd say we've gone from passive to passive aggressive. And if I look at that strategy, even if they get everything they want, what are they doing? Accelerating the demise of Exxon? Like, I'm not sure that's the answer either. I think ESG 2.0 is active management, because I think you get what you inspect, not what you expect. So when I went around thinking about how to devise an ESG strategy, I started with a blank piece of paper. And I sat down with my ESG advisor, who is the founder and former CEO of SASB. And we said, let's define materiality. What is the problem? It's decarbonization. Right? If the Arctic goes from 31 to 33 degrees Fahrenheit, that's the difference between swimming and skating. This is a problem, right? So then, right. then you need consensus around what is material. And in the equity markets, there is no consensus. It's like the ratings agencies pride themselves on being different, which is very confusing, and it doesn't drive capital the way the debt markets do. In the debt market, you don't get a company rated investment grade by Moody's and junk by Fitch. It just doesn't happen. There's a consensus around materiality. So what we did, and we think it's highly disruptive, we want an entirely different framework. We believe that there's a radical new way to measure impact and investability in decarbonization. And this is how we think about it in our portfolio. These companies have a fiduciary duty to decarbonize if they tell us they are going to. So I look at that numerator and I say, great, your carbon footprint is independently measured and audited. I'll take that. Now show me your CapEx. Let's break it down. Where and how are you investing in decarbonization? And then if your carbon footprint is coming down, right? I can tell the efficiency of your carbon renewal. So, and that's holding them accountable. And that's different.
Well, and it's interesting. You talk about format. Laura, come on in, because I think you have created a new format for companies to really take an inward look at how they are doing things, how they sell products, how they do services. You're not maybe directly involved in ESG investing, but you're changing the proxy seasons. There are, issues being brought up that were never brought up before when it comes to the practices at companies. Talk to us about what we're doing. Do you really think companies something's happening, that they are looking much more inward when it comes to their biases and how they approach customers and clients and how they do things?
Yes, and I think this conversation that we've just had about ESG is the exact reason I wrote my report that's coming out today. It's called The Rationale for and Key Elements of a Business Civil Rights Audit, because we don't want greenwashing type activities in the civil rights spaces. Over 500 Corporation said something after the murder of George Floyd, and there were a lot of good statements, and there were charitable contributions, and there were a few good programs, but companies need to go deeper. And so I've outlined what I think is a set of baseline practices for companies to use if they are serious about ending discrimination within their own walls. And it goes further than diversity, equity, and inclusion. I mean, we're asking questions like, we want companies to ask questions like, are my products hurting communities? Do people with disabilities have access to our platform? Are we locating toxic waste plants in minority communities only? Is our facial recognition software working on people with darker skin? And how do we address those practices and make companies more equitable so that they stop hurting people? People don't want all of these platitudes, just like you have in the ESG space, that we're a green company and we're anti-racist company. The time for the platitudes is over. It's now time for companies to get down to the serious business of self-examination. And this is what the civil rights stakeholders and worker rights stakeholders are calling for.
Well, Barbara, you brought up too, engine number one. Folks, let me put it out to you. Tariq, was engine number one a sign of progress in terms of getting, those 3 seats on the ExxonMobil board earlier this year? I've talked to engine's number one CEO just last week at Milken. She says, I hope Exxon will change its business model, acknowledges it will take time, but is that a step in the right direction?
I mean, it's
like
marginally, it's marginally helpful in the sense that, they can go and push a more aggressive view around the need for Exxon to build a newer model based on, transitioning to renewable, just like tobacco companies are becoming, vaping companies or whatever. There's no question they can push that faster, but the fact remains that absent regulation, they're going to go onto the board of an oil company and have a fiduciary duty to shareholders to maximize value. If the core business model of that company is harming society's interests, then it's pretty simple. They're going to have to lose money, right? ExxonMobil's they're not going to make as much money as they otherwise would have, absent science telling us that we can't exploit all the fossil fuels out there. And some of these solutions, they worry me because they just, imagine if in the 1950s, the answer to evidence that smoking causes cancer was not that, and think of like responsible business and like civil society. The answer wasn't that we should go out there and ask the government to, tell these companies to disclose the risks, put it on the box, regulate the sale to minors, which obviously saved lives, right? Instead, the answer was that we act like the government doesn't exist and regulation is not a tool in the toolbox. And instead, the answer is one-by-one proxy fights against tobacco companies so that you can get on the board and have a fiduciary duty to shareholders to tell them to sell less cigarettes. It's the same reason I look and say, well, in the post-World War II period, we have to ask the question that the outcomes on economic inequality were better from capitalism in the U.S. in that period. The S, let's say, not all S areas, but some of them at least running economic inequality. The E, you had, Richard Nixon founded the EPA in 1970. We didn't have ESG. We didn't have a parallel financial system of green assets, right, that was purporting to undo what the regular financial system was doing. And it's because I would argue that, regulators are at the, more aggressive about saying there's a divergence between short-term incentives of many of these players in the system and the long-term public interest, right? Those are negative externalities. And
Carol, I have a question though.
Yeah, go ahead.
We keep talking about ESG as if it only has to do with environmental issues. And I thought there was a social element in it. And I want, people to focus on what ESG broadly means, not just the environmental impacts. I think that's really important.
Well, Laura, do you feel like we're making progress on social? Or go ahead. Do you feel like, Laura, we're making progress on social?
I think there's greater awareness, but, the ESG people in a corporation sit over here, and, the diversity and inclusion people sit over there. and the CEOs are kind of left off the hook. The CEOs and the boards of directors need to be held responsible for all of the components of ESG. And, we're talking more than diversity and inclusion when it comes to race. We're talking about making sure your products are not harming people. And so what we are really seeing, I think, is an opportunity for leaders to lead and to embrace all elements of ESG and say, okay, let's agree to some standards here so that we can measure it. Because if we can't measure it, we can't fix it.
Agreed. Barbara, come on in on this, because I think we need to think, we know there's a problem. And there's a lot to be done.
It's all about measurement, whether it's carbon accountability or gender accountability. What is the numerator? What is the denominator? What is the rate of change? And what did it cost you to get that change? This is the way I think about any big problem, because you need the trajectory and you need the pace, or you're not going to hit that target, whatever the target may be. But the other thing I think was quite interesting was when Tariq talked about the taxes on carbon. I don't want to be engine number one. I want to be the little engine that could. And if we're going to accelerate this energy transition, we need to invest in the copper and nickel and all these things that are historically taboo for ESG. And, Tariq, you're in Canada, you have a $40 per ton carbon tax. That's really interesting, because I can find carbon and nickel companies that are mining in net carbon neutral ways, and they will never have to pay that tax. So it's the idea of turning carbon from a liability into an asset by getting ahead, using your CapEx to get ahead of that huge liability. And these are the real ESG leaders. And these companies that are led by such visionary CEOs, Laura, they're engaging, their communities, and they're really positive about it. So they tick every ESG box. But I agree, you have to have a holistic approach to this. And those are the companies that I want to hold out as ESG leaders and get money to. It's not Salesforce, it's not Facebook, it's not Google.
Tariq, how do we do this, though? I think about quarter to quarter, especially if you're a publicly held company, we're looking at your top and bottom line. We're looking at all these financial metrics. We're all judging a company based on them because those are the accepted ways, that a company is measured. You have the, regulators who decided what needs to be done by companies when they do their financial reporting. So how do we kind of hold a company feet to the fire when it comes to ESG metrics and being better, really better? How do we do it?
It's difficult, right? Because, as you mentioned, the system is very short-term oriented, right? It's capitalism. There's an initiative that BlackRock's one of the founders of, actually, called Focusing on Capital for the Long Term, FCLT. And it's sort of a think tank that has all kinds of research that shows that, to your point, capitalism becomes very focused on the next quarter. That I think sort of is central to the premise that certainly for the E in ESG, that you're not going to find an incentive for the players in that system to invest in long-term sustainability changes if those pay off in 10 or 20 years and they get paid in the next few, right? Can they do? There's a lot of tools and things that they can employ, and I think a lot of people great things. But my worry is the incentives they remain to do things that are in short-term benefits of the players of the system, but not in the long-term public interest. And
but
those,
you know what?
those.
Come on in, Laura.
But you know what? I think when we look at incentives, we also have to look at the workforce. Millennials are the most diverse workforce. They want more from their companies. They want to work for value-driven companies. And as companies look to the workforces they want to hire and the communities that they want to serve, they have to look at other metrics besides profitability. But that being said, all of the companies that engaged in civil rights audits, Starbucks, Facebook, Airbnb, none of their profitability suffered as a result of doing this deep analysis. So I think we shouldn't set ourselves up to have this false choice where you're either for profits or you're for ESG concerns. I think you can do both.
I don't disagree,
Barbara,
but one thing.
Go ahead.
Sorry.
Go ahead, Tariq.
One thing I'd say is that their profitability didn't suffer, but I'm not sure how much progress was made against those social goals. I mean, the household income gap between black and white families is the same as it was during the civil rights era, right? So, when I look at it, I'm not jaded, right? To your point, Barbara, I'm just a realist, And I look at the system now, and I just turned 43. The majority of the people younger than me don't believe in capitalism. That's a fact, right? The majority of millennials don't believe in capitalism, the oldest of which are turning 40 this year. Gen Z are even more cynical if you follow what Greta Thunberg said with her recent blah, blah, blah speech. They're increasingly becoming convinced that this is a system, that capitalism itself doesn't work, right? Because the only version they're seeing of it is one that is not solving long-standing social problems. And so while I agree that we need to build tools, and I think companies can do better, I'm doubtful that if we leave it to voluntary compliance on the most important issues, we're going to see significant amount of change, right? At the speed that that's.
We only have about 4.5 minutes left. So where do we go from here? And I know, Tariq, you've talked about that we need to think about ESG just like we thought about COVID. And you say, in some of the writings that you've done, the nine words we need to hear to build a sustainable future. I'm from the government and I'm here to help. So the government needs to be active, just quickly.
I think that we should release the chains of neoliberal ideologies that say that free markets solve all problems. Look, the solution to inequality, if you ask Tom Piketty, is raising marginal taxes, historically marginal tax rates on the wealthy, right? You ask William Nordhaus, who won a Nobel Prize in economics, he'll say that you need a price on carbon and a bunch of other solutions. We don't really get there if there's a reflexive anti-taxes and regulation angle. And I'm not saying, again, lots of other things can't be done in it, but systemic problems require systemic solutions that change the incentives of the players of the system so that they serve the long-term public interest. I think the biggest part of the debate and the biggest part of that change is going to come through government action.
Barbara, you think, though, I guess what the investment industry needs to kind of agree exactly what ESG is and the materiality of it?
Yeah, but I mean, if I just want to take another angle of ESG and pick up on what Laura was talking about, just about diversity in the industry, collectively, minorities in our industry run 1.3% of the assets. So what can we do to change that? Like, let's talk about solutions. It's very powerful for someone to write Ontario teachers or CPPIB or Texas teachers or any of these big pension plans and just ask them, what does the diversity of their asset allocation look like? That would create a very uncomfortable discussion in the boardroom, and that's something anyone can do. So when you talk about change, it can come from the bottom. It doesn't always have to come from the top. And so I think people need to feel empowered to stand up for the change they want to see in the world.
Laura, what do you think that we need to do to really be thinking about and how we make it better and put the right policies in place, especially when you have prominent leaders like Jamie Dimon of JP Morgan saying, when he was asked about corporate civil rights audits, he said they amounted to bureaucracy and BS. You are working with companies.
Jamie Dimon seems to change his mind a lot, so I'm not worried about what he says. But I do think the investment community, the activist investors, the pension funds, are really something to pay attention to. There were at least 8 racial equity audits put forth in shareholder meetings earlier this year, and they got like 30% and 40%. I mean, Tom DiNapoli, the comptroller of New York, put something before Amazon calling for a racial equity audit. It got 44% of the voted shares. So corporations and their leaders are going to have to pay attention. And I do think government action is very important, but historically, government action follows social movements. And so I think we're seeing a social movement with investor communities, with stakeholder organizations like workers' rights and civil rights organizations. And we also saw legislation introduced this year, or being introduced by the chairwoman of the Congressional Black Caucus, Joyce Beatty, on requiring companies to do racial equity audits. So I think there are storm clouds brewing, and a smart company will get ahead of the storm and not wait for the government and hold themselves out as leaders in this area.
And let's not forget, we see BlackRock earlier this year. They're going to do a deep dive into their business with a racial audit. Color of Change, influential racial group, they're calling out a lot of tech giants to conduct race audits. Citigroup just became the first Wall Street bank to a racial audit. So maybe some baby steps forward. We just have about 40 seconds left. Final thought quickly from each of you. Tariq. Do we have audio?
Sorry about that. I think Laura is right that diversity and inclusion areas are hard to audit, and they do come from social movements, so I agree with that. I think for environmental and economic inequality issues, I think you really need to to get the government to move.
Barbara, final thoughts.
I wanted to thank you for the panel. I think conversations like this are key, right? If you can't talk about it, you can't see it, it just gets buried. So thank you.
You guys gave me a lot as a journalist to think about and ask guests. Laura, final thoughts.
And I'll just say, read my report. It comes out today. And just ask yourself whether or not corporations can do more on their own, or they're going to wait to be sued or, legislated by Congress.